Welcome to the WangHiro podcast, where we answer Malaysians' burning questions about personal finance with fact-based answers. Listed in 2004 on the ACE market, known as Mesdaq then, OpenSys is a company that offers solutions to financial services, telecommunications, and utility industries. Started as a 10-man team in 1996, today OpenSys is best known for their efficient service machines, or ESM, which supports most major banks in Malaysia. Last year, OpenSys transferred from the ACE market to the main market, allowing it a broader access to capital. On top of that, its solar marketplace, buySolar, has gained traction with climate awareness growing. Today, we're asking, is OpenSys worth investing in? Welcome back to Stock Investing from Zero on WangHiro, a series where we put a beginner's lens on companies to help you decide if you should invest in it. We do this by asking 4 questions. What do they do and how do they make money? Are they profitable and financially stable doing it? Who is their audience and how big can they grow? And finally, are they cheap or expensive? So John, let's start with the first question. What does OpenSys do?
I think anytime you go to a bank, you will likely meet an OpenSys machine. Yeah, you know, when you go and you ask money from the wall.
Ask money from the wall, that's a very interesting.
Yeah, so
Okay.
how I even came out with this phrase is actually not mine. So I had a Greek colleague when I was in Shell, and he was trying to educate his 2 daughters on money. And what happened was, what's the problem, Daddy? If you don't have money, you just go to the wall and ask for more.
Oh my gosh.
Yeah, it's his 5-year-old daughter that time, very cute, right? He's Greek, wife is Spanish, so they have 4 passports among them, you know. So yeah, so they actually run 6 different businesses. I'll briefly go through each one of them. Okay, so the first and probably one of the biggest where they started is actually this thing called a cash recycling machine. So it's not actually recycling. It's actually, so a lot of times you go, it's an ATM machine. That means dispenses money. But at the same time, you have a different machine for where you deposit money. So now you see more and more it's a 2-in-1. That means it's both a cash deposit machine or it is an ATM at the same time. So they have actually programmed it into a 2-in-1. In the past, during my time when I was starting out as started working, a lot of these machines was actually made by foreign companies, you know, Wincor Nixdorf, Siemens Nixdorf. I don't know if you've seen Nixdorf, and it's a German company. Those were the ATMs in the early days of the 90s, the early 2000s, right? And what we're seeing more and more is that it's localized because the people here have the expertise to actually build these machines, you know, get the security system up to scratch, all that kind of thing. So that's the first part of the business, a cash recycling machine. The second part of the business is more manpower related. It's a business process outsourcing. So what do you mean? That means that you have a bill payment kiosk. Usually you have to have a counter, you have to man it. Now they have this kiosk. You go to a Celcom, it's 24, let's say a Celcom branch. They have a kiosk out there. You scan your bill, you put in a credit card or you put in cash, whatever. That's a business process outsourcing for that part of the business. The third is actually maintenance and software solutions. They'll come to you. They'll actually, like, if you go to Post Malaysia, you know, if you want to think about like, I think Post Malaysia mainly will deal with MyEG lah. But if you think about people like Celcom, you want a scanner for your barcode, you want a machine that actually prints out like a receipt and all that kind of thing. These are the parts where the maintenance and software solution will come in. That's the third part. The fourth part is actually this thing called Smart CIT. It's their secure logistics. Okay, secure logistics. So, you know, like if you transit cash, right? You carry cash from an ATM machine to another ATM machine. I think it's you need to be secure. You need to track. Okay, and also sometimes you want to be more efficient rather than, you know, I guess a lot of people think that today, Malaysia, post-COVID, we have a lot of people already going on digital payments, right? But that's very far from the case. Actually, I did a statistical study. 64% of transactions in Malaysia are still done in cash, actually, Louis.
Wow, that's surprising.
That's
That's
surprising,
surprising.
right?
Oh,
Yeah,
that surprised me. I thought it would be like on the minority.
30s, yeah,
Yeah,
30,
yeah,
20,
correct,
yeah.
correct.
No, it's not.
But I
And
thought like when you said 64% would be only 64% cashless, which was already like, wow, okay, that's low, but like that's cash.
yeah, there's cash. And you think about the hawkers, your small time hawkers and all that, it's
True.
still predominantly cash. In the Klang Valley, it's very common now to have, touch and go, Grab, that kind of thing. I think in Sarawak, they have this Sarawak Pay thing, right? But a lot of other transactions are still done in cash. And I think that there is still a need for this service of handling of money. Okay. The fifth one, pretty interesting. They created an online market space for renewable energy, which is called buySolar. We'll talk about that later. And last but not least, the sixth is branch of the future. I think what they're trying to portray for branch of the future is like more and more 24/7 do it yourself, self-help kind of machines will actually man the branches rather than having an officer there. So an officer there will likely do higher level stuff lah, in a way, process your loans lah. Even loan processing is all centralized already. It's more like account opening, all that. I think more and more this branch of the future will see machine automated processes. I think that's where they are trying to encourage that.
That's for banks, is it?
That's right. That's for the
Oh,
banks. Yeah.
okay.
If you go to a bank today, right now, I know this from talking to people in the insurance industry. Insurance industry, especially some of the larger insurance in Malaysia, you notice almost every town they have one branch, right? Yeah, even like small places like even the Telok Intan, there is an insurance office there. Okay, as long as there's agents serving the community,
Sure.
it's likely to be right. Now, the struggle is that is the highest operating cost for an insurer.
Oh,
Yeah,
that's interesting.
yeah, you have your underwriters, everything centralized. Okay, you have your reinsurance costs, all that. But operating costs in terms of branch, you'll be very surprised how much it costs because there's overheads, rental, okay, and most of the time it's like inefficient use of space. Yeah, very efficient use of space. So I think this branch of the future thing has a little bit more leg room, a little bit more tailwind for OpenSys. Yeah. Yeah.
Interesting. I mean, John, it just feels like when I was like looking up OpenSys, is so diverse in what they do, right? 6 different.
Yeah, 6 different like.
Are they like, I'm trying to understand, are they actually related at all? Most of them, or
Yeah, very 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 related because
like especially the buySolar one though, it's like quite.
buySolar I think is not directly related, but I think where they're coming from is a lot of these solar panels require financing because it's not cheap. So for them, I think adjacent space is that how can I provide credit when I'm already running business where ATM machines, all that kind of thing. You're getting consistent cash flow, because there's actually a retainer for maintaining all these machines, so there's consistent cash flow. But for you to grow, I think they need some kind of ESG team or ESG new energy kind of like direction that I think they're quite smart. Hey, I don't want to go into building solar panels myself, but what are the problems or needs that these people who want to have solar panels face? So, like for example, most of the banks want to provide financing, but for them, they may not have the digital automation tools. They may not have the ability to build that kind of. So, I think it was quite smart. Adjacent space. I have my bunch of programmers. I already know, like how to build payment gateways, how to make sure all this transaction is done in a secure manner online. So why not? And I think this is a very brilliant move to add ESG kind of like rating for them.
Interesting.
Yeah.
So it's more of like I already have all of this expertise. I see there is a opportunity, then just like pounce on it.
Correct.
Okay, very
Correct.
smart.
Correct.
Very
Correct.
smart.
Yeah. So let's go to the second question is, are they profitable and financially stable doing that? So I'm going to just show my screen. Right. So as you can see, revenues has been really flat and dwindling. And I'm not surprised during COVID. I think most people don't use ATM. Everyone is gone online, trying to pay digitally and all that. So I think that really took a beating. Okay. In terms of margins, you see gross margins are like it's starting to creep up, 47%, 38, 37, which is quite healthy. I mean, what you're seeing is that they have some sort of a pricing power that they can pass on to the consumer with these gross margins. Operating margins about 18%. It didn't used to be in the past. You look at 2016 only 8, high single digits. Let's look at net margins. Net margins, you're talking about what? 13, 14, 18%. Interesting. Profit to the company, net income has grown. As you can see, right? Even though revenue is kind of flat, 94, 96, and then starting to drop. But as you can see, profitability is double that of when they had more revenue. I don't know if you noticed that, Louis. Here they had 94 million in 2016, but they only had 6 million in profit. Whereas in 2022, December last year, they had lower revenue, 82 million, but higher profit. So they have switched to more of a higher margin kind of product or service, which is a good thing. Okay. I always joke.
But like, is it like also because they have less like growth? Could we say that? Like, are they like investing less capex intensive?
That's where you have to go and look at the cash flow, because cash. I always joke, Louis, that you don't pay staff salary on net profit. You pay them on cash flow. And cash flow is also increasing. No, decreasing. No. Okay. Last year decreased. Okay, let's see. What did they do? They depreciated slightly more only. Okay. But the receivables started going up a little bit. That's why. Okay. To your comment or clarification on capex, you actually look at this thing called cash flow for investing. So cash flow investing is actually where you will be able to see whether they're spending money on capex or not. Like in this case, not really a jump. As you can see, on average, -2 million, -6. Not a significant jump, huh?
Right.
Yeah, not really. I think very asset light. Virtually, you are a service provider that makes machines to the banks.
You're virtually printing money.
Yeah, literally you're printing money, literally printing money. So cash flow for investing is not really jumped, except for year 2020. They pump in more money. Where did it go? Okay, capex didn't really increase. It's this one, investments in marketable and equity securities. This is the one that caused the jump. Okay. Their free cash flow generation, quite interestingly, has been going on the uptrend, except for last year. I think last year, okay, changes in working capital. Yeah, but otherwise, you talk about operating cash flow, quite healthy. If you look at the balance sheet, should be a net cash company looking at it. Let me see. Since you're minting cash already, right?
Basically.
Yeah, it's net cash. Is net cash. You can
always say to be very close to the money. They are so close. They should be making a lot of money.
Should be. If they're not, then something is wrong. Something is wrong. Yeah. So profitable, definitely. Sustainable, looks like it. Profit margins are going up, and net profit is going up, even though there's a flat looking kind of revenue. And it doesn't seem to need a lot of capex. Okay. And I think the capex is being borne by the rental. I think they will depreciate or amortize it against the rental that they're getting from all the banks. Okay. So who is the audience and how big can this grow? Now, this may be a problem because right now they're predominantly in Malaysia, right? So Malaysia has quite a high bankable society as well. I think 80% or even 90 if I last recall. So in terms of like new growth of new branches or whatever, it's less likely to happen now with more and more banks trying to adopt digital banking. So here is one of the stagnating growth problems in terms of like new branch opening, additional of new machines. I'm not saying it will like die off. I still think bank branches are still very relevant in today's day and age. But at the same time, the counter argument is that even though bank branches are reducing, but the staffing of branches are also reducing. That means they are relying more and more on machines. You see where I'm coming from or not? Rather than initially, if you open a branch, you have 20 people.
Yeah.
Now you put more and more machines, right? And it's open 24/7. This may be that space where OpenSys will benefit from it.
Given if they are able to adapt to all the business processes that the banks need, right?
Correct. Correct.
But that's only looking at the machines space, right? For that part. But how about the rest? Like how can we analyze what kind of audience does it have, like especially for that buySolar bit?
Yeah, I think buySolar will be interesting if they gain traction. Right now, they have not like put in that kind of detailed, what's the brand, all that kind of thing. They may be a trade secret. Okay. Actually, if you go and look at their current website, it's quite easy to use. I like the user interface of it.
Yep.
Maybe let's do
I like
this.
the website. That's a pretty friendly looking website compared to most.
Yeah, it's not overly cluttered. At
Yeah.
the same time, it's like the way things are laid out is like it's quite good.
I think it's because they themselves are solution providers, right?
That's
So
right.
they don't do the UI very well.
Yeah, I like this bit though. It's like current
Oh,
electricity bill.
calculator. Yeah, calculator.
Yeah,
is also
yeah.
good, John.
Too bad I live in a condo, so I can't take advantage of this. Okay.
Oh, really?
Yeah. I
Put it
mean,
outside, lor. Just paste it there.
paste it on my wall, right? Is it nothing wrong? Right? All the walls surrounding my condo area can be used as a
Yeah. But I don't know if the structure can support or not.
Yeah.
Then the wall will fall.
Yeah. So in this case, I think in terms of profitability and all that, in terms of the audience size, sorry, I do hope that this will be a growth factor for them, because in terms of banks, I think it's stagnating. Even though there is a digitization push, but I think it's stagnating. A lot of people do everything online now, a lot of it, right? And if they grow regionally, that could be another,
So does it mean that they need to? I mean that's their the main segment at the moment. That's why we are focusing on that.
Which one? You mean the cash register? Yes. I think that's where, in terms of the cash recycling machine, that actually brings in a big chunk of their revenue lah. Yeah. So in terms of what do you call it? In terms of growth, I think the business process outsourcing, the in terms of the solar, I see that as catalyst for growth for the company. And more importantly is this, I think in terms of the ability to, provide a one-stop solution to you, because the banks, right, they don't want to be bothered about all these tiny things. They just want to say, hey, I outsource this to you. I like hands off. Okay, you go and settle all the movement of money, replenishing of the money, the what do you call it, the all the data sets, all the insights that you're getting from all these transactions. You one stop shop for me. Okay, I just worry about the more profitable parts of the business, like credit, virtually giving loans, whatever. And I think that's one of the reasons why they saw this buySolar as an opportunity, because really banks make money when you give out credit. That's where you really get spread. Yeah.
That's very interesting. And on the same line of thought, it could be any business, right?
Correct.
That's an opportunity in this space, right?
Correct.
Where people need a lot of credit and can't get it easily.
That's right. That's right. Actually, I do want to clarify, even though I said earlier that the ATM machines and all that make a big chunk of the money, actually it's really their maintenance and software solutions. So it's like, if you have the hardware, it's usually a one-off, but the big chunk of the money will actually come from maintenance software solutions related to this business as well. That is the biggest revenue generator actually right now.
It's the ongoing fees, right? I think
Yes.
it's at the same machine, right? That we're talking about. Okay.
That's right.
Okay.
That's
I mean that means the rest of the segments that we see are still, wait and see lah. We don't know yet.
Correct.
Because we don't have the data, so
correct.
can't make a decision on whether it will grow or not. We don't know
Yeah,
yet.
they'll buySolar is not even a line item there yet. Okay, so
Oh,
it's not even a line, because they only have a few line items.
But it's still under the same company, right?
Yeah, it is. Yeah. So I think last but not least is actually valuations, whether they're cheap or expensive, right? So looking at it, if you're talking about last 12 months, about 13 times. Okay, if we stretch it a little bit, Well, 2013 they had a bad, minus. Okay, I think they had a loss that year. If you're talking about next 12 months, they don't even have an. It's all trailing. Okay, it's good trailing. You talk about. Yeah, I think in terms of average valuations, 12 to 13 times. Historically, I don't think it's. Let's look at 10 years. Okay, during COVID, it did peak lah, about 25. Okay, this is the highest. Let me see. This is probably 30 times. Did it go up to 30 times? Nope. I think it's roughly about 20 over times. No, the highest was 28.9. Close to 30 times. Close to 30 times of the of their multiples of their profit. Okay. Competitors wise, I don't recall reading about a close enough competitor, especially as wide as they have, in terms of like having the cash recycling machine and maybe more related to the foreign companies, the Wincor, Nixdorf, and all that. But you see, right, if you're a foreign company, let's say you're a German company, you want to service the banks here, and ATM is 24/7 one, if something breaks down, whatever, you want someone who is locally based.
Yeah.
So the cost of, being local support here is actually very, very expensive comparatively. So I think what OpenSys has an advantage is really like being local, being here, available to serve their clients more in a more rapid response kind of manner lah. Yeah.
But could it be also like their competitors are not direct, like what you said, customers are shifting in their behavior. They're just moving away from even, the ATMs themselves.
Yeah.
Then
Yeah.
other things are their competitors, right?
Yeah.
Because I think something is more abstract.
The other, you're right. The other, what do you call it, competition, so to speak, is the convenience of online, people getting used to it. I mean, like, if you think about the Gen Zs or alphas that are coming up today, right? They are digital natives. So for them, check, ATM is alien to them, It's like, it's an alien concept.
Like there are a lot of young people that I've met.
Uh-huh.
They don't even have an ATM card. They don't even have an ATM card. So, I mean, I'm like, I was like, because I also run retail, like, do you have an ATM card? You can get some money there, right, to pay in cash because their card didn't work there.
See.
No, their QR didn't work. I was like, you
okay.
can go and get your. It's like, I don't even have an ATM card.
My goodness. So how do they withdraw money?
They don't. I don't know why or how. I'm like, okay. Then she's like, I've been using this way for.
Wow.
I don't know how it works. I'm like, okay. You don't even have an ATM card. That's a lot of people actually. I was surprised to learn that quite a number of people now don't really use ATM cards.
Wow, interesting.
That's an interesting shift, right? So when you remove even that process of withdrawing money and then they're just transferring money between different platforms, you see. Like they get their income, let's say through Maybank, and then they will transfer that to a e-wallet.
Yeah.
And then use the e-wallet most of the time. They don't use ATM.
Yeah.
Okay. So in that case, would you say like, okay, something like an e-wallet would be their competitor or something?
Yeah,
like
definitely. E-wallets, I would say even credit cards are their competitors because I hardly go to the ATM. I probably do it once a month. And why is because I have to pay my maid in cash. I can't pay her in like touch and go.
Oh.
So
that's true. That's true.
Yeah. So that's one of the main reasons why I go and withdraw. And to buy, you see, even like small ticket items today, you go to a MyNews, you can pay in touch and go, RM1, 60 cents, everything. I really hate carrying loose change. Like the 40 cents, 30 cents. Wow, it pains,
And I think the retailers sometimes like prefer for you to do that because they don't want to carry too much loose change.
Correct. For them, they also don't want to because you see, a lot of people don't understand. Handling of money is more expensive than electronic transactions. Someone has to pay. That's why MasterCard, all these payment networks, they charge 3%. It's because for you to move cash, I think the likelihood of the cost being is actually more expensive. People think it's cheap. A lot of retail hawkers, they don't want to get on board the digital bandwagon because now I have to pay 3%. But then you think about it, they are pushing that burden to the bank, Louis, because they go in, Okay, let's say they made like 5,000 ringgit today, right? Hawker. They go to the bank they puts it into a CDM machine, cash deposit machine. Someone has to pay for the secure armor services to actually carry that money. And then what happens if in between the hawker before banking into the CDM, he gets robbed? He or she gets robbed. So that's cost there, you know.
True. And I think another reason why on top of the transaction fee is the waiting period.
Yes.
Yeah, so you have to wait like a T+1, T+2, you know, to get your money, which for them, some of them they told me that, you know, it's too much time to wait. Yeah.
I see.
But for me, like the do it now is very fast.
Yeah.
Do it now. It's like immediate and there's no fee. So that's the best solution so far. And until do it now announces the fees again.
Yeah, until
Yeah. Then maybe the hawkers will remove it. Okay. So I didn't really get your valuation. Was it cheap or expensive?
I think at the moment I don't have a benchmark to say whether it's cheap or expensive.
Because of the lack of concrete competitor, right?
Correct. Unless I go and view a similar business somewhere in Thailand or Indonesia or whatever. Yeah, but since it's a start from zero, obviously you need more reading time to get to that.
Okay.
Yeah.
Okay, so some final questions before we move on to our next section is like, as I was reading it, I was like, oh, you know, this is interesting that they started off at the ACE market, now they're moving to the main market. What does it mean? And then, does it mean anything? I mean, what do these markets like mean? What's the difference? And then, does it matter to us as investors that this happens?
Yeah. It does, because the moment you are so ACE market, you think of the tiers main market, ACE market, and LEAP. Okay, I'll start at the lowest and I progressively go upwards. For a LEAP market, for you to buy the shares, you can only buy the shares if you are an accredited investor or sophisticated investor. What does it mean? You must be net worth of 3 million and above. The reason why they do this is because they say LEAP markets are smaller in size, so you think of it as like more the startup kind of venture, more risky. And in order for you to like understand or take a risk, they rather have someone with a higher net worth that, you know, can lose this kind of money. And yet, what I find very for me pretty ironic is that it's more highly regulated than ECF, whereas ECF is more risky than the LEAP market. You think about it, ECF, you don't even need to be a sophisticated investor, and you can put in 100,000, 10,000, kind of that one. Obviously, there are some limits to ECF, how much they can put in. Okay, I can't remember exactly, but here you have someone go through the entire listing process on LEAP. Okay, make sure it's profitable, make sure there's no hanky-panky, make sure, okay? But then you need sophisticated investor for you to buy, okay? What happens is, because only sophisticated investors can buy, liquidity is very small. You don't have liquidity because how many sophisticated investors, even if they are, some of them don't want to go through the hassle to declare their assets, you know. You see what I'm coming from? Okay. So that's LEAP. Second is the ACE market. ACE is, you think of it as like secondary school, secondary school, okay. Slightly more liquidity because you don't need to be a sophisticated investor, but at the same time, you're usually not on the radar of what I call institutional investors because your size is not big enough. Institutional investors are people like your EPF, your PNB, or even people like JP Morgan, their asset management side and all that, because, or your BlackRocks for that matter, because one, if let's just say you have a market cap of 100 million, right, and you only have 25% of it readily available for the public, that means you only have 25 million worth of shares to buy in the open market. So if you're BlackRock and your asset size is how many trillion, 5 trillion, 6 trillion, you come in, you one fund, right, one ETF, let's say one ETF is like 1 billion US, right? They're not going to be bothered taking a position in a 25 million free float available company, So when you go over to the main market, hopefully your market cap reaches like 1 billion, or even let's say at least 800 million ringgit, right? So 800 million ringgit market cap, 20%, 25% of it, you're talking about 1,600, so probably about 200 million. Then it makes sense for an institutional fund to come in and want to invest in you and that kind of thing. And you get more visibility because you kind of like now in university. So you think of like lead board as primary school, secondary school is the ace market, and then main market as for you to get to be on the main market. There are certain criteria that you need to fill, like how much revenue per year. I think it's 60 million if they have not changed it. Minimum, cumulative for 3 years, you must have at least 60 million kind of revenue, and then profit of 10 million cumulatively over 3 years. Yeah. So the higher lah. So you think of main board as the highest tier lah, the university tier lah.
There's like all the I think there's also like all that liquidity, right? Increased liquidity.
Correct. Increased liquidity. Because you see, for any fund who is big in the world, they need to spend time, effort, resources to do research, to allocate and to buy. But if you do not have the enough shares for you to buy, it's not even worth it. You must be a great company, but my fund is so big, I'm not going to spend like the same amount of time.
Can't even put like 100 million, right? They're like, oh no, I cannot.
Yeah. Don't waste my time, they'll tell you this.
Yeah. Okay. So that wraps up our stock analysis on OpenSys. So now let's move on to our next and last section, which is the investing book recommendation. So what's the investing book that you recommend our beginner listeners today?
Okay. So it's a cute book. It's a cute book.
Cute because of the word little, right?
Yes. So it's actually by a very, very famous investor that so low profile. I think we should do him in one of the episodes as well.
Greenblatt.
Joel Greenblatt. Okay.
Another famous investing figure that most people have not heard of, John.
Correct. and the best part about this, Louis, is that you should listen to some of the episodes that he has given, the interviews he has given, right? He was sitting behind in an MBA investing class, and his professor was going about efficient market hypothesis. So efficient market hypothesis talks about, okay, the simplified version of it is this. If there's 100 ringgit or 100 US dollar bill that actually falls on the floor in a very busy street, and if you look at that US $100 and no one has picked it up, it's likely to be fake. That's the efficient market hypothesis, because it said it's likely to be fake is because there's so many intelligent people that have looked at the $100 bill and never picked it up, and they just walk past. So that is the meaning. So that means like on Wall Street, because of the internet access is so open, that the moment there is news about a particular company or information about a company, the market will be efficient. Right. So
it's not an altruistic market. Right? It's not like, oh, nobody's picking up because, oh my gosh, it's not mine.
Yeah, and not only that, they'll just say they'll say it's fake, because they say that it's impossible that this market, this 100 ringgit $100 bill is available, right? Because so many people has passed it, right? This opportunity is not going to happen. So he kind of detests that, Louis, and he said nope. And then when he read Buffett's writings, and then he said, this makes sense. And Joel Greenblatt, I wouldn't devote too much here, but he's actually a specialist in this kind of investing called special situations. So I'm going to describe it in the next episode when we talk about him. But about the book, okay, let's talk about the book. So in this book, he actually gave the audience or the readers this thing called a magic formula. Okay. And the magic formula combines two key financial metrics. The first one is return on capital, and the second one is earnings yield. Now, I rather go into these two things first, because I know some of the audience out there, they may not fully understand return on capital. Return on capital is this: you think of you giving $1 to the business, and from that $1, how much can the business generate? So most companies in the world, is very, very difficult to do double digit consistently. So if you give them $1, they'll probably give you like 8 cents back, 6 cents back, But to consistently deliver like 10, 20%, 20 cents every year, I think it's only a handful of companies, less than 1,000, not that many. Okay. The second part of the magic formula is this thing called earnings yield. Now, earnings yield, you think about it, most people think about PE, right? It's the inverse of PE. So let's just say your PE is 10. So earnings yield will be 1 divided by 10. It doesn't give you, it gives you a yield where it's easy for you to compare to things like fixed deposit. Because PE is a multiple, the unit is a multiple, earnings yield is a percentage. So if they give you earnings yield of 3%, That means you can compare it to a fixed D of 3% or a dividend. Then there's another one called dividend yield. So like dividend yield gives you a 3% yield, right? That means the dividend you pay, that the company pays against the share price, that's your dividend yield. So yields make it easy to do a equal to apple comparison for percentage units and investment returns. Okay. The third thing that he talks about is actually strategy. So he actually gives indicative size how big your portfolio should be. Nothing more than 25 and nothing more than 30, sorry. Anywhere between 25 to 30 is best. So when you think about 25 to 30, that means if you equally balance all the stock in your portfolio, one stock should not exceed 4 to 5%. Because if it's 25, 100 of 100%, that means every stock of 25 stocks, it should be 4% and nothing more. Okay. So he didn't advocate for 100, he didn't advocate for 10, There's a scientific number to this. Someone has did a study, Louis. You cannot reduce the volatility reduction of anything above 16 stocks doesn't matter anymore.
Okay.
If you have like 5 stocks, volatility is very high.
Makes sense.
If you go up to like about 16 and then 16 above, right, the increase in number of stocks does not significantly reduce your volatility anymore. So that's why I'm very quite in alignment in Greenblatt strategy anyway between 20 to 30 lah. Okay.
Interesting.
Last but not least, I think one of the key, there are many other points, but I'm trying to simplify it. Last but not least, he says, when you look at investing, it has to have simplicity. So if you look at the magic formula that he's given, right, it's very much a simplified way that even an inexperienced investor can actually apply with ease. So understand the concepts of return of capital and earnings yield. And from there, you can actually get, to apply the magic formula.
Okay. What I find interesting is that there are actually like practical guidelines in this book that you can like just dive in and then use straight away. I know a lot of our audience always ask about portfolio, like division, asset class, how much should we do this, that, and actually it's in books like these, right, that we can just take a look. And I mean, are these like hard and fast guidelines, or like can we deviate a little bit, do you think?
I think put it this way,
and,
right?
and secondly, does it apply to all markets?
I'll answer the later one first. It applies to actually all markets, but all markets have their nuances. And only when you start investing yourself, then you will understand these nuances. Like, for example, you invest in Malaysia, you have to be used to high PEs. Good companies, 30, 40 times, very common. Very, very common. Why? Because a lot of institutional investors has local mandates like EPF, like Co-op, like PNB, right? They cannot invest too much globally. So because of that, good companies are far and few in between. And when local institutional money put into these companies, there's always this sense of heightened valuation because of this mandate lah. So it's kind of a nuance for Malaysian markets. You go to US, right? You go and look at a company, even though they're global, scalable, right? People will balk at paying 50 times, 60 times PE. You see? Yeah, whereas in Malaysia, it's very common to see like tech companies that you pay 40, 50, 60 times, which actually is very, very risky, to be honest. Okay. To the earlier question about is it practical, applicable? Yeah, I think it is, because to a certain sense, you can straight away find out how to calculate ROC, but for you to master the real concept of it, that takes years. Many, many years, because what does it mean? It's a number, it's a formula, but unless you've read enough companies, enough industries, you really understand the concept of ROIC. So you think about ROC or ROIC, return on invested capital. What kind of businesses require lots of capex, factory, inventory, all that kind of thing? And for you to expect high ROIC in those kind of companies, if you find one, what does it mean? Then again, when you see ROIC very high straight off from a startup or a company that just listed, what's the nature of their business that makes it like so special? And is it something sustainable or not? So I think concept-wise, you can pick it up very fast, but the real understanding or embracing of it takes years of practice and investing yourself.
Just we can just use this as a starting point, right?
Correct. Correct.
Okay. All right, got it. Okay, so that wraps up today's episode of Stock Investing from Zero. So over to you, our audience. Are you an investor of OpenSys? What's your outlook on the stock? Leave your comments below. And if you enjoyed this video, do give it a thumbs up, like the video, and make sure to subscribe and hit the notification bell on our channel. Thank you for tuning in today, and we hope to see you again next week. Bye-bye.